Here we go. Diagonal spreads, everything you need to know. So first things first, what is a diagonal spread? Ultimately, a diagonal spread is a vertical spread, a debit vertical spread, whether you're buying it at the money or slightly in the money. There's trade-offs. There's no better or worse scenario, but there are trade-offs that we'll talk through. But ultimately, think about it like this. It's a vertical debit spread that you're buying, where the short option has a shorter term expiration than your long option. So we've talked about inventorying delta. That's another way to think about it as well. But really, at its core, a diagonal spread is nothing more than a vertical debit spread where you have more time to expiration on your long option. It allows us to get a covered call or covered put feel if we're using put options to be bearish with a fraction of the risk. Typically, I would say we're using more call diagonal spreads than put diagonal spreads, especially in this market where everything is just down. But we'll talk about different setups and different things to look for. And there's actually a really interesting differentiation between the call and put side in Tesla, which is where our visuals are going to come from today. Are absolutely more dynamic trades when it comes to the Greeks. If you're comparing this to a covered call or a covered put, where you're actually buying 100 shares or shorting 100 shares. And that's because you have a variable Greek nature to the long option instead of just the short option, since shares of stock do not have varying vega and theta numbers because it's just delta. When it comes to the setup, we like to look at the front month versus the back month implied volatility. But really, again, we're just looking for a longer term option to purchase, and we're looking at a shorter term option to sell against that long option, which is our asset in the trade. And we want to collect as much as possible for selling that short option while also keeping it close to expiration. So that's why we like to trade these for earnings primarily, because you can set your short option the weekly expiration. You get a massive implied volatility infusion because of the binary event. So it's a decent setup and can result in profitable legs on both sides if you are directionally right. But ultimately, we want to look at purchasing the long option in a cycle that has baseline IV. So when we say baseline IV, we really mean a low implied volatility number, preferably in the 30s or 40s for an equity. 20s, that's great too, but you're probably going to see the 20s more for ETFs. But usually a cycle that has IV in the 30s or 40s or lower, and the IV number itself is comparable to further dated cycles. So if you see 35%, 36, 37, 35 in the back months, that's kind of what we want to see, because it shows us that while there can still be a vol collapse, we're probably not going to get hurt too much if it does happen. Selling a high IV short-term option against it, the long option that we buy, helps us reduce our cost basis aggressively. And when it comes to where these strikes are placed for a pure diagonal spread, if we were to separate a poor man's covered call and poor man's covered put from diagonal spreads, usually the differentiating factor is going to be the long option being around that 40 to 50 delta. So using an at the money option instead of an in the money option could be the differentiator there. But for the short, we're looking at around a 20 to 30 delta. We can do longer duration trades, and I like to go as far out as possible with the long option, as long as it still makes sense with the different checkpoints that we like to look for. And moving that long option further out in time further disassociates your purchase from implied volatility, which we'll talk about in a second. It's much more about theta value that you're buying, or extrinsic value based on time relative to implied volatility the further out in time you go. And if you have a longer duration time frame on the long option, it just allows you to continue to sell short options against it if you're wrong, or if the stock's not moving, and you can continue to reduce basis 2, 3, 4, 5 times instead of 1 or 2 times if there's a small difference between your long and short option expiration. The main thing here is we want to make sure that the total debit paid doesn't exceed the spread width, and that just helps us maximize the in the money profit potential if our spread moves fully in the money. We have made exceptions to this before, but that exception completely relies on the fact that our short option is in the weekly cycle. We're typically not going to buy a diagonal spread like a $10 wide debit spread, we're not going to pay $12 for it if our short option has 20 days to go. You're putting yourself in a tricky scenario because now you have risk in the money side.
Yep.
At the end of the day, defined risk, this is a defined risk trade. So the max loss potential is the debit paid up front. And because of this, it results in a high return on capital trade or potential high return on capital trade if you're directionally right. But it also protects us against huge moves against us, which we've seen many times where a stock goes 30, 40, 50 points in the wrong direction. We only have the risk of the debit paid up front rather than the undefined risk nature of, selling strangles or something like that. And really the big thing for us for earnings trades and diagonal spreads is because you can't adjust your risk when the market's moving after the options market is closed, unless you're buying shares or shorting shares. It's just a more defined risk feel where you know that you can only lose the debit paid. So this is what the diagonal spread looks like. This is a Tesla call example, and we'll look at the call side input side, but ultimately an example of this. So Tesla's right around 280 right now, buying the at the money option in the 53-day cycle in November, and then selling an out of the money option against it for a pretty big chunk of the value of the long option. So the long option you're buying, that's what you want to appreciate in value, or at least hold on to its value as the short option decays. You're going to see a slightly positive or flat theta, simply because, yes, your short option that you're selling against the long is worth much less, but this $3.75 goes to zero in 18 days. This 26.30 goes to zero in 53 days. So you have this temporary positive theta feel and kind of a mulligan feel, which we'll talk about in a couple of minutes. But ultimately, if you look at the buying power, this is a $2,200 trade. It's a 30-point wide diagonal spread. So if you get the move right, you can make upwards of $1,000. And this is just a real-time theoretical risk where we're not looking at the expiration of the short option. If you move this to the expiration of the short option, you can see you get this nice big spike as the stock potentially moves up, because again, this 310 call goes to zero. Your 280 call would certainly appreciate in value if this happens in the next 2 weeks, and you could be profitable on both legs in that scenario. So keeping an eye on how this risk profile changes is going to be super important.
And you can see the net delta there being somewhere between 20 and 30-ish deltas net on that position. So we look at that buying that 40 or 50 delta, selling a 20 to 30 delta. Net, you have 20 or 30 deltas on the position, and that'll grow if you are directionally correct on that position because of the gamma, which is something we're going to touch on as well.
Yep. To the downside here, same sort of setup. So this is another 30-point wide diagonal spread. But the big difference here that I noticed immediately was the fact that this is a cheaper trade. So if you're buying an at the money put, you can see the at the money call, $2,600, at the money put, $2,600. But in the short term, Tesla actually has pretty aggressive put skew. So looking at the 250 put, 30 points out of the money from 280 versus the 310 call, 30 points out of the money from the long call here. This 310 call is trading for 385. The 250 puts trading for 565. So almost $200 more in premium, and you're paying basically the same amount. Now, this doesn't mean that this is a better trade, because if Tesla rips up 30 points, your put diagonal spread is going to be a loser. But this does play into the near-term put skew, which we are seeing in Tesla, and that's why you're getting about a $200 discount here. But same sort of thing. If you look at the real-time movement down towards 250, you could see $1,000 win on your $2,000 buying power in debit paid, which is a big return on capital if it happens. And at expiration of the short option, you can see you get that same sort of spike. So this is simulating this option losing all of its extrinsic value, your 280 put gaining value on the way down. So these are potentially high return on capital trades because you are defined risk, because you are staggering the expirations, taking advantage of certain things, especially on the put side here. In this example, that certain thing you're taking advantage of on trade entry is that put skew. But what can we do if the trade goes wrong? We'll dive into that shortly. But first things first, I think profit targets is always the subjective thing we get the question on. It's like, I'm paying this amount. What sort of profit target should I shoot for? If I close the short option, if I just leave the long option, now what profit should I shoot for? So let's talk about that.
Yeah, so your profit targets are kind of variable slash subjective, but you have to keep in mind that the width of the spread from your the difference between the long option and the short option, that's the max intrinsic value that you can get out of that position. So if you have a call diagonal and the stock goes up significantly, that intrinsic value it maxes out at that short option. So the position is a combination of a long spread plus the extrinsic value of the further expiration long option. So you have that added extrinsic value, that's your kicker. And if that extrinsic value goes to zero, the intrinsic value is the max you can make. And that's why it's important to pay less than the width of the spread, because in the extreme tail event, that spread width is going to be your max value. And if you're paying more than that max value, you could potentially have risk if you are directionally correct to the tail side of your direction. And that's why, in the same light, the tighter diagonal spreads will actually start to have negative theta decays, because if you get that big move in your direction, your short option, the extrinsic value goes to zero, but your long option holds that extrinsic value. So you'll actually lose money as time passes. So it's important to keep in mind the width of the spread relative to the debit you're paying, because that's the max intrinsic value. But also to keep in mind that if you get that directional move correct in the short term, you kind of become neutral / against your current delta. You want a move back to where your short option is if you do get that big move in your favor. Max profit on this position. So you're going to be at max profit or near at max profit at the short option, at the short option's expiration. So you want to move in your direction, but not a huge move in your direction. We've talked about this setup as sort of a way to get long premium and long a call or long a put, but also have a sort of mulligan built into it, because you're giving up the tail profit potential in exchange for some positive decay in your favor and a potentially higher upside if you do get that inside move in your direction. I'd say realistically, your target for the profit potential on a diagonal spread is somewhere between 25 and 50% of the debit paid on the position. So if you're paying $10 and the width is a $10 difference between the long and the short, if that spread went to $12 or $13, that would be a home run type trade. And when you think of a return on capital standpoint, it's a huge return on capital as well. So you want to consider volatility, delta, and most importantly, the gamma and how fast the position has moved. So this is more so applicable to the shorter duration short option. So if you're doing this as like an earnings trade where you're buying a 30 or 50 day option and then selling a 1 day or a weekly option, if you get that move correct in the short term, your position goes from a 30 or 40 delta to an 80 or 90 delta. Just because that long option is in the money, it'll go towards 100 deltas, and that short option is going to be decaying fast and coming off the table in a quick amount of time. You get the swings in your P&L will become much greater moving forward if you do get that direction right with an earnings type diagonal spread. So you've got high Greek exposure, so you can scalp out of these positions. If you put on a call diagonal and the stock moves significantly the next day or 2 days or 3 days, you're probably seeing a 10 or 15 or 20% profit relative to the debit paid. Definitely, something that you can consider managing in that respect. And on this sort of setup, gamma is your friend. The position gets bigger as you're more directionally correct. So if you're doing a call diagonal spread and the stock goes up, a couple dollars over a couple days, your delta is actually going to grow, and the next couple dollars gets bigger and bigger from a profit standpoint in your favor. Vice versa on the downside, I mean, you don't lose as much delta to the downside because you have that short option that's coming off the table quicker. So you kind of maintain that delta in the short term. Again, that's kind of your mulligan there. For management, so you can roll the short option further out in time. We can do this week to week. If you're doing something like a 60-day long option and then a weekly option, you could do that week to week. If you're doing a longer term, like leap sort of position where you're going 100 or 150 days out in time and buying an at the money option, you can sell 30 days shorter options or 40 days and continue rolling those out in time until you get to the long options expiration month, which turns the position into a long debit spread. You can get funky with these positions because you have this longer dated long option that defines the risk, and it's going to hold the extrinsic value. So you kind of have some flexibility, especially with wider diagonal spreads, where you can add defined risk in a shorter duration against the diagonal spread. I've done this a couple times recently with SPY and a couple others in the past, selling a shorter duration short call spread against an in the money diagonal spread that's gone in your direction. That turns the position into like a calendarized butterfly type position because you have the butterfly risk profile in the short term, and then you have the added kicker of the extrinsic value further out in time. So there is some flexibility there. It typically doesn't use additional buying power, or maybe just a little bit additional buying power, but ultimately it's a defined risk spread, so you don't have to get crazy with the management here.
Yep. And real quick, your best case scenario with these strategies is your short option being right at the money at expiration, because that allows you to realize the full intrinsic value of that debit spread. Plus, your long option gets to hold on to as much extrinsic value as you can while still being fully in the money. So that's why when Nick says, if you get a big move, you actually want the stock to move back to your short. That is why.
All right, couple quick tips. So delta will increase as the spread moves in the money. So you get a little bit of added leverage in the sense that it's a cheap way to get potentially 2 or 3 times the delta if you're directionally correct. So you start at 20 or 30 deltas, long or short. If you're directionally correct, that could go to 50, 60, 70 deltas in the short term, which comes from that gamma exposure that you have on the position. It's a very high gamma exposure on a diagonal spread, which leads you to have dynamic deltas as well. So if you are correct, you get more correct as that position continues on. The extrinsic value in the shorter dated option has a higher theta than the longer option. So you're going to have slightly positive / flat theta in the short term. This is your mulligan. So if you're directionally bullish and the first couple days the stock doesn't move, you kind of get that mulligan / hedge coming from that shorter duration option that's going to go to zero quicker than your longer dated option. You can roll this, if you're directionally correct, into a poor man's covered call type position. That comes with being directionally correct. You sell that shorter dated option, you roll it forward, and you create kind of a poor man's covered call type position into strength of the position. And lastly, this is a great source of delta, but it's also a positive gamma and positive vega position, which, when you compare to a lot of our trading strategies, short strangle, short spreads, iron condors, these are, positions that are mostly short gamma and short vega. So if you're looking at your positions and you're saying, I've got a lot of gamma risk, or I need to get, a decent amount of short delta here, but also I want to get, potentially more short delta on a down move. This sort of position is kind of opposite of everything else we trade. So it kind of offsets some of those Greeks if you feel like you're getting, overexposed in short vol, overexposed in gamma, or, you need some quick delta. This kind of fits the bill.
I love it. I worship these strategies.